Want to welcome everybody onto this call. If you've been on this call before, today this is a topic that we've called the horse race, and I think it not only is it more relevant now than ever before, but I think as most of us on this call, we start to think seriously about our retirement, we have to understand the roles that taxes play and the exposure to the risk, not just market risk, but tax risk. So without further ado, we'll get started. And then again, if you have any questions, comments, whatever, you can certainly get back with us at the end. So by a show of hands, this is audience participation. If somebody wouldn't mind typing into chat, do you think that taxes in the future will be, and I'm talking income taxes, do you think they will be lower, the same, or higher? Go ahead and type in your answers. There's no right or wrong answer here. I just would like to know from a polling standpoint, what people think. So thank you for playing. So we got, one higher, anybody else higher? Okay. So if that's true, and again, I don't know, right? But yeah, probably not lower. So thank you all for participating with that. So let's take a look. If you've not seen this chart, there is a lot going on here. But if you have a pen and paper in front of you, you can go look at this real time. It's called usdebtclock.org, all one word. But I point out there's some important information here that the first thing I point out to is this U.S. national debt. We have now exceeded 32 trillion with the T. I'm not going to talk to you how unfathomably the magnitude of this number, but it's a big number, right? And then, as you think about it, what I relate to is when I first started showing this, you're going to hear me reference David Walker later. The U.S. national debt was about 6 or 7 trillion. So a little under 15 years, right? We've run up an extra $25 trillion. Now that number's large. Now, the next number that's on this screen is 102 trillion. That's all total U.S. debt for every American, every child, every parent, every grandparent, brother, sister, every American. So those are just, again, magnificent numbers. And then if we look at how much money we have coming in to offset it, to pay for the things that the government has already agreed to pay for, it's only 4 trillion, 4.6 trillion. Now, you don't need to be a math major to understand that our government in the past 15, 20 years has a spending problem. So, again, I would encourage all of you, because when you go to the live site, you can actually curse over each of these different areas, and it will talk about, right, what each of these different numbers actually mean. So I share that with you because I'm in agreement with those of you that said, yeah, that it's probably going to be higher. Well, now let's look at some things that we were encouraged to participate in. So most people on this call have at some point in time heard of IRAs or 401ks, 403bs, TSPs, any of these things. Those are tax postponed. When you postpone something, typically that means it has a negative connotation. So if we're postponing the taxes, doesn't mean that the money's going to not be taxed, not tax-free. It just says, hey, like Wimpy from the Popeye commercial, I'll gladly pay you Tuesday for a hamburger today. The government has given Americans this sort of deal that says, hey, listen, don't worry about it. Pay me later. But they didn't tell you what when they were going to call the note or when they were actually going to charge you for deferring or postponing the money. So we're going to apply some math to this. This way we can be completely neutral, unbiased, and just look at things with clear vision or clear goggles. So this calculator is a calculator when we're using, we teach and train our advisors. And again, I've shown this before, but it's been a while. But I think it is more pressing as this number continues to rise because there is storm clouds on the horizon. We cannot continue this. But before I go off on a tangent, let's just understand what we're looking at here. We have three color horses. We have a blue horse, we have a yellow horse, we have a green horse. Now, we're going to treat all these horses in the race equally. We're going to put in $10,000 into each of these accounts. We're going to let them grow at the same amount, 10% every year. And we're going to tax them both on the growth phase and the distribution phase exactly the same. And if we were to have taxable environments that are both on the upside and on the downside, well, one of the things that jumps out at us is that the $10,000 going in for 20 periods will pull the same amount out, which is $67,275, that both the Roth or tax-free and the tax deferred end up in a tie. It's an absolute equal race, right? But what is lesser understood here, or not as obvious, is that the blue horse gets crushed. So what does that mean in layman's terms? What it means is that a lot of us, in an effort to save money, right? We know that we can put money into IRAs, 401ks, there are restrictions, there's limits. How much can you do, right? Because we want the deduction today. We don't want to pay the taxes today because, you know, we were told that in the future, they're going to be, we're going to be in a lower tax bracket. Oh, I get it. So where else do you put your money? CDs, banks, brokerage accounts. And at the end of the year, whatever growth rate you've had, you get a 1099. You get a 1099 INT or a 1099 DIV, and that gets reported on your tax return. If we were to turn around and pay the taxes from that account, obviously that horse finishes in third place. So that's why of all the places we can save money, it's not the best place. So we know that, hey, tax deferred and tax free has advantages, but that's in a, what happens if we do end up in retirement in a lower tax bracket? Well, let's look at that. If we turn around and change the equation, we still put the 10,000 in, the 10% interest, but in the accumulation phase, we were actually in a higher tax bracket versus the distribution phase, which we drop it 10%. So, you know, and now we're down to 20%. Well, then the IRA 401k qualified plans, they win, right? They win little over $500,000, $600,000. So this is all the advice that most of us are buying into because this is the bill of goods that we've been sold. But most of us on this call, when I've asked, I don't think anybody said lower, but if that were true, then the math supports that answer. But my experience has shown me, and most people's belief system, that they're shifting away from that lower mentality. And I'm going to add some validity to that here in a moment. But understand, just because it probably was true, you know, 10, 20, 30 years ago, it's probably not true on a go forward, but yet we're still doing the same old, and we may end up getting hit by a train. All right, so what if taxes are higher in the future? Well, then qualified plans that grow tax-free, they come in first place. And again, just a 10% gain. Now we have a big difference again in the favor of tax-free. So the last point I want to make here is that the blue horse doesn't win in any scenario. So if you have a brokerage account and you're getting 1099s and hey, the bank's paying me 5% on my CD. Okay, I know that. That's better than it's been in 10 years. But remember, that's not 5% you get to keep. Because by the time, even at a reasonable tax bracket, 25%, you're going to net 3.5, right? So depending on your tax bracket. So then you go, wow, that's what we call going broke safely. You have to understand that as we start to save money and accumulate it, we have to be efficient from a tax perspective. So arguably this gentleman here, one of the smartest men to ever live, and he was quoted as saying one of the most difficult things in the world to understand is U.S. income tax. And what I try and do is simplify it here. And this is just showing you the 2023. Think about it. Back in your science class days, we used to have graduated cylinders. So if we had the graduated cylinder here on the left, this is what our tax bracket used to be in 2017. And then the TCJA was introduced, which stands for the Tax Cut and Jobs Act. And it morphed into the graduated cylinder on the right. And that's the current environment for a married couple right now. Now, part of what I want to explain here is that not every dollar is taxed at the same rate. So if you earned 100 grand, $22,000 of that is taxed at 10%. Anything up to 89 is 12%. And then anything over that, then you take all those numbers, you combine it, and that's an effective tax bracket. But this is called marginal tax brackets. And so a lot of people, sometimes they get confused when we're talking about taxes. What is it we think they're going to become in the future? Just understand that right now, this is our current tax environment. Now, I have some numbers up here in the right-hand corner, these red numbers, 1/1/2026. This is already law. This is happening. On 1/1/2026, this graduated cylinder on the right side is going to revert back to the graduated cylinder on the left-hand side. So now, the government's been spending money. We've been, I'm not going to get into any political conversations, but understand we're at $32 trillion of debt. If we were to run a business the way the government is running this country, the business would be bankrupt. So we have to start to think, and you start to think back where the government's, was just downgraded on some of its, bond holdings. So, when the creditworthiness of the U.S. economy starts to even marginally, it's not, the market's not crashing overnight, but long term, it ends up, being a problem, and it can start to have really negative pressure on our returns and our opportunities in the future. So understand, this is coming. This is already happening in about 2 years, right? So we come to, if you're a single file, so you say, well, I'm married. Yeah, but if, there are things that can happen if a spouse passes away, right? If you are currently single and it reverts over to the left, that's a pay hike or a tax hike, right? So there are a lot of things that we should be aware of. And that's why dealing with the competent financial advisor, professional planning services, this is one of the areas where we have deep, in-depth conversations about to make sure that we're at least aware of the tides and the winds as we're navigating and moving towards and through retirement. So again, the same numbers are on the upper right-hand side, but a couple things could affect a married filing jointly. And again, that could be either a death, a divorce, or just in fact, you're already single. So either one of these things can have an impact on how much of the money that you currently have saved you get to ultimately keep. So this is why I brought up this slide, because a lot of people, and I think there's one person on this call that used to, I think I met at New Jersey 101.5, and I used to play his video. And so, he was, David Walker, for those of you who don't know him, you can Google him. I've never met him, but I was so stunned by his acclamations, his yelling from the rooftops. The next slide, but was the head of the government accounting office. He's, was on the board of Social Security. He's basically in the CPA Hall of Fame. He was like the country's #1 CPA. And he was a comptroller general on both sides of the aisle. No political preference one way or the other. Basically what he was saying was, this is math, folks. Our country cannot sustain it. But here's what he quoted as saying. In his opinion, regardless of what politicians tell you, any additional accumulations of debt, absent dramatic reduction in the size and role of government, basically are deferred tax increases. Unless we begin to get our fiscal house in order, there's simply no other way to handle our ever-mounting debt burdens except by doubling taxes over time. Now, I was doing a class up at Rutgers at the business school up there when I was pre-COVID, and one of the people that attended that class during that meeting, when I put this slide up there, they said impossible. There would be a revolt. And I go, not only is it possible, it's happened before. So let's look at our history. Most people are not familiar with our tax history in our country. Our income tax was created in 1913, and it was a temporary tax. That's all the way here to the left, and it was 7%. Okay. Now, if you turn around and we go, $1 million is, let's just say, I'll keep it for it's keeping the math simple. And a lot of people, they feel like, hey, if I get $1 million in my retirement account, I'll be able to retire. Okay, I'm not here to tell you whether that works or not, but I want you to pay attention to a couple things here. This green line in the middle of the slide is our average taxes in this country since inception. So that temporary tax, it started at 7%, fast forward over 100 years, and that temporary tax is still in force, and the average is 57%. And then what I also point out here is that taxes in this country used to be as high as 94%. Think about that. This has already happened. Go back. You can look up history. So if 94% was federal, there was an actor that only did 2 movies a year. He was paid $100,000 for each of them. And when asked, why do you only do 2 movies a year? He goes, because anything I earn over $200,000, the government keeps 100% of my money. And he goes, what do you mean 100%? He goes, when you're earned over $200,000, plus he lived in California, the 6% state tax, that was 100%. He said it did not make sense for him to work. So when you think about that, that's already happened. And that actor's name was Ronald Reagan. So when we come back and you look at where we are now in this lower tier over here, we're actually in a lower tax bracket than we've been in the past. And if you follow along with our marginal tax bracket, and I don't know who's in what tax bracket on this call. So whether you're, the question I'll normally ask somebody is, of that $1 million that I see in your retirement account, how much of that money is yours? And most people will start off with, all of it. Yeah, well, there's a lien on that account, like I talked about. You haven't paid the taxes on that yet. So if you're in a 24% tax bracket, then that means $240,000 you get to pay the government as you withdraw it. If you're in a higher tax bracket, 33%, then you have even less. And I'm not even putting growth rates on it. But if David Walker is correct, and taxes double, and you're going down this path towards retirement. And I can tell you, there's no lobbyists in Washington, 401k lobbyists defending our retirement accounts, right? The government is just viewing this as a pool to tap into to balance the budgets to get reelected. But that doubling becomes 330,000, becomes 660,000, becomes 66%. It's just over the median. It's not even like that out of the question. So that's the alarm. That's the concern. And that's why a lot of I know are contributing to Roths. Some of you have taken the steps to put cash value life insurance. So 7702 and 72E of the tax code allow you to build out like what I call giant Roth-like vehicles that allow you to put more than just what the rules are. And it doesn't tie your hands if you need to get at some of the money, but they have to be built and designed. These plans that were originally built, the 401ks, the IRAs, they're restrictive. And they really do inhibit the ability to use that. If an opportunity comes along, you want to flip real estate, you want to do whatever to try and to get ahead of the game, it makes it very, very tough. So my point is, history has shown that taxes have been higher, much higher in the past, and they're likely to gravitate back towards their means. So that's my story. There is no call next week. For those of you that don't know, my daughter, Madison, it will be her 16th, sweet 16. And so they have not been on a Disney cruise in a long time. So I decided to help them celebrate. We're going to be floating around on a ship. I'm going to have a lot of fun. So I will not be here. I will see you after Labor Day. And for all of you, I want to thank you for being on this call each and every week. And if I can help you in any way, please reach out. But if I don't respond to you, you got questions in the next, until after September 5th, I'll get back to you.